What is your sense from a market perspective as to what is happening here? Is there anything new?
Hi, guys. Not really, I don't think, no. I mean, what is new, I suppose, is the tone of the comments. But I think that's related almost entirely to the fact that the real deadline, is getting closer and closer. And it is just in the nature of negotiations as you head towards the end point of a deal for both sides to dig their heels in ever more. But I think with both sides still very firmly keeping an eye on an end ambition of striking a deal. So I think the market's taken it fairly calmly, but we would suggest there's going to be more volatility over the coming days, even though the end point for us, and I think for the markets, remains the likelihood of some sort of deal which keeps disruption to a minimum over and after year end.
So just focusing on the cable rate for a second, is it the asymmetric risk to the up or the downside based on that?
Well, if you look at where we are now, certainly in terms of the sort of trade-weighted level of sterling, we're actually almost exactly in the middle of the range that we've traded in for sort of nearly 4.5 years now, ever since the referendum, and roughly 5% from either extreme that we've seen over that period. We would say on conclusion of a reasonably clear deal which leaves disruption minimal, we'll head back towards the top end of that range. That's probably the limit of the upside, as long as there's all of these other risks clouding the outlook for the UK economy. On the downside, I think if the deal really falls apart, the market genuinely is not expecting that, and there's probably significantly more downside. We'll certainly head back to the lower end of that post-referendum range, and probably another sort of 5% beyond. So we're talking about, a sort of 10% move or so on from or thereabouts from here. So around parity on euro sterling would be our expectation.
John, I'm trying to understand how this all affects inflation. Is the right way of thinking about this that no deal is inflationary because you get that big move in sterling that you just talked about and you get a significant hike in tariffs, and a deal is disinflationary because the pound pops higher, you don't get the tariffs, and you still get the effect of sort of the COVID story that is coming through? Is that the right way of thinking about it?
Yes, I think it is, Guy, although I think on top of that you have to layer in the fact that a deal probably, and I'm just for the sake of this conversation leaving COVID to one side, but in itself that deal probably gives a bit of a boost to UK sentiment and activity, and at the margins that's sort of domestically a bit more inflationary. And equally, if there's no deal, although you get a spike in prices because of as you say, the fall in sterling and the imposition of tariffs, you probably get a bit of weaker domestic demand offsetting that. The important thing in terms of the rates market and monetary policy expectations is to remember that the MPC has published explicit guidance saying they don't intend to tighten policy until essentially the output gap is well on its way to being closed. That's going to be way after the end of this year, after the pandemic, and after the UK economy has grown well for a period and replaced this pocket in demand, the air pocket in demand that we're seeing, unfortunately, as a result of the pandemic. So for policy, I think a spike in inflation on the back of a no-deal Brexit doesn't mean anything for rates. The MPC is not going to tighten into that sort of inflation.
OK, what about cutting? At the moment, I think we've got 10 bips price. What is it, July, August for next year? Do you think that is the right pricing in terms of cutting? Do you think that comes forward at any point, and what could be the catalyst for it?
We think it's broadly right in that, to put it simply, a cut is more likely than a hike over the next year or two, basically. But we still think it's a pretty low probability that they do cut into negative territory. Although they're preparing the ground, I think everything they say tells you they really would rather not go there. They're far from convinced that it's an effective policy response, and they worry about the impact it would have on UK banks. But if we get a no-deal Brexit, and especially if on top of that we're getting sort of bad news, economically speaking, from the worsening of the pandemic and perhaps, hopes of a vaccine dashed and so on, they may very well have to go negative. We're not expecting no deal. We're not expecting, ever worse news on the pandemic into next year. So we don't think negative rates is likely to crystallise, but it is still a possibility in those worst case scenarios.
What else can they actually do?
Well, they can certainly do more QE, as they like to keep reminding the markets, and indeed we think they will in a few weeks' time. If they're more and more worried about the outlook, that QE will be greater in size or more rapid in terms of the pace of purchases. They can also change the terms of the term funding scheme to make it cheaper for banks to access money and potentially do it for a longer period. Lower the fees on that scheme, which has a much more direct pass-through to the corporate lending markets, we would suggest, than simply cutting the policy rate. And there are obviously other schemes they can do in terms of supporting credit markets and giving incentives to banks to lend more aggressively to the private sector. Those things we think would be more effective than cutting rates to negative territory. And for us, although it is a tool in their toolbox, as they've told us, we think it's sort of well down the list of what they're likely to practically do in the near term.